Hello everyone, and welcome back to the Web3 Daily, where we're diving into the latest market movements. After a pretty wild weekend of volatility, the market seems to have found some temporary footing and is staging a modest rebound. Bitcoin is back above the $114,000 mark, and Ethereum has reclaimed the $4,000 level. But have you noticed? The overall trading volume is actually shrinking. What does that tell us? It suggests that most investors are still on the sidelines, feeling cautious and hesitant to jump back in. So, this current price action feels more like a technical correction rather than the start of a new bull run. Capital is clearly favoring Bitcoin, while the altcoin scene remains a bit chilly. Overall, the market sentiment is still conservative, with everyone waiting for a clearer signal. For now, patience and risk management are key. Alright, let's move on from the market overview to what I think is the most fascinating topic buzzing online today, because it involves a giant we interact with daily, Tether. When you hear Tether, your mind immediately jumps to USDT. But what if I told you that Tether's ambitions have grown far beyond just being a stablecoin issuer? They recently made a massive move, restructuring into 4 divisions: Tether Data, Tether Finance, Tether Power, and Tether Edu. My first reaction to this news was, that's a brilliant play. This isn't just business expansion. They're building an unshakable tech empire, and in the process, a regulatory firewall. Think about it. Regulators are constantly scrutinizing your USDT reserves, which is like a ticking time bomb. But now, Tether is essentially saying, we're not just about stablecoins. They have Bitcoin mining farms, green ones, and that which effectively counters the whole ESG argument. They're investing in AI and peer-to-peer communication tech, laying the groundwork for Web3's infrastructure. And they're pushing education globally, cultivating users and building their ecosystem. It's reminiscent of Amazon. You might think of it as just an e-commerce site, but AWS is the real beast. Tether is doing the same thing, transforming itself from a simple financial tool provider into an indispensable tech infrastructure giant. Once they reach that point, regulators will have to think twice before making a move. What's even more interesting is that these 4 divisions aren't operating in silos. They're designed to create a flywheel effect. Tether Power's mining farms can supply cheap green energy to Tether Data's AI centers. The tech innovations from Tether Data can then empower Tether Finance's next-gen platforms, like the asset tokenization they're developing. And Tether Edu continuously funnels users and developers into all these ventures. Once this ecosystem gets spinning, its competitive moat will be incredibly deep. So, stop seeing Tether as just a USDT issuer. It's playing a much bigger game, evolving from a controversial financial tool into a foundational piece of the future digital economy. The ambition and the vision behind this move are something we should all be thinking about. Now for our first major story of the day. And this one is an absolute bombshell. I think its long-term impact on the industry could be even bigger than a bull or bear market cycle. U.S. Department of Justice just pulled off something massive. In a multi-agency operation, they seized $15 billion worth of Bitcoin. You heard that right, $15 billion. The funds were confiscated from a Southeast Asian criminal organization known as the Prince Group, which was heavily involved in pig butchering scams and money laundering. When I saw this news, 2 very strong thoughts immediately came to mind. First, this is the loudest possible slap in the face to the tired old narrative that cryptocurrency is a criminal's paradise. For years, outsiders have associated Bitcoin with money laundering and illicit activities, thinking it's untraceable. Well, here's your proof. $15 billion, a massive sum, was tracked and seized with precision. This demonstrates to the entire world that a large-scale criminal activity on the blockchain can not only be traced, but the assets can be recovered. The significance here is that it fundamentally cleanses the industry's reputation, removing one of the biggest psychological and compliance hurdles for the large traditional institutions still hesitating on the sidelines. So, while it's a crackdown on crime in the short term, it's a massive long-term positive for the health of the industry. My second thought is that a new unpredictable whale has just been born. The US government itself. They've previously mentioned creating a strategic Bitcoin reserve. This seizure of over 100,000 Bitcoins instantly makes the US government one of the largest Bitcoin holders in the world. And this is where it gets interesting. Think about it. A typical whale buys and sells for profit. But the US government operates differently. How they manage these assets, whether they slowly sell them off or lock them away as a national strategic reserve, will be driven by national policy, fiscal needs, or even foreign relations. That's a completely different game. So from now on, when we analyze the market, We won't just be looking at macroeconomics and institutional moves. We'll have to add a new variable: the US government's treasury management strategy. This introduces a new layer of geopolitical uncertainty into the market. Alright, let's move on to the next story. If the last piece was about enforcement, this one is all about prevention. Coinbase, the largest compliant exchange in the US, recently teamed up with blockchain analytics firm Chainalysis to launch an initiative called a Sprint. Their goal was crystal clear: to crack down on criminal networks using cryptocurrency to traffic fentanyl. Why do I find this so important? Because it reveals a profound shift that's happening right now. Compliance is evolving from a passive cost center into a core competitive advantage for exchanges. Think about it. In the past, the general consensus was that exchanges just needed to meet basic regulatory requirements like KYC and AML. But what Coinbase is doing now is going on the offensive. They're not just meeting the requirements, they're actively investing real money to fight illicit activities. Using Chainalysis tools, they analyzed over 17,000 transactions, mapped out complex fund flows, and then packaged that intelligence to be shared with law enforcement agencies in 12 different countries. This sends an incredibly powerful message. For institutional investors with deep pockets but a strong aversion to risk, like pension funds or sovereign wealth funds, what's their biggest hesitation about entering the crypto market? It's the fear of being associated with illicit funds, which brings regulatory and reputational headaches. Now, Coinbase is stepping up and saying, look, we are the cleanest, most secure platform. Not only are we clean, but we're also proactively helping law enforcement catch the bad guys. By taking on this industry responsibility, they're essentially selling the scarcest commodity of all: trust. So, when Coinbase does something like this, it's not just spending money on compliance, it's building its deepest competitive moat. In the future, when institutional capital floods into the market, which platform will they choose? The answer is obvious. It will be the one that offers the highest level of security and regulatory certainty. That's why this collaboration between Coinbase and Chainalysis isn't just a technological victory. It's a brilliant strategic move. It signals that the future of competition in the crypto industry won't just be about trading depths and fees, but about a battle for trust and security. Alright, let's move on to our next story, which comes straight from the global financial capital New York City. Mayor Eric Adams, who has always been notably crypto-friendly, just made a significant move. He signed an executive order to officially establish New York City's first ever Office of Digital Assets and Blockchain. Even though his term is nearing its end, the symbolic weight of this action is huge. When I saw this news, my first thought was that the global race to become the world's crypto hub is heating up. You've got Miami, Dubai, and Singapore all rolling out favorable policies to attract crypto talent and capital from around the globe. By establishing an official crypto office, New York, the long-reigning financial center, is essentially defending its turf. They know that if they fall behind in this new wave of fintech, talent and capital could easily flock to other cities. So this isn't just a local policy, it's a strategic move in the global geo-economic chess game. Another key takeaway for me is that this signals a major shift in how governments view cryptocurrency. The focus is moving from retail speculation to institutional infrastructure. When Mayor Adams first took his salary in Bitcoin, it was more of a personal statement, catering to the enthusiasm of retail investors at the time, but establishing a formal government body dedicated to compliance and industry coordination is a whole different ballgame. It shows that the conversation is no longer just about short-term price fluctuations. Instead, it's about building a stable, compliant, and long-term framework that can integrate with the traditional financial system for projects focused on enterprise applications, asset tokenization, and serving institutional clients. This is an incredibly positive signal. It tells us that crypto is moving from the fringes of speculative hype and is starting to be taken seriously as a constructive force by the mainstream. Okay, next up, let's talk about what might be the clearest and the most disruptive real-world use case for blockchain technology to date: cross-border payments. There's a strong consensus forming among industry analysts right now that Circle's USDC is perfectly positioned to upend the massive $20 trillion global cross-border payments market. Some are even boldly predicting that USDC has the potential to supplant fiat in certain areas. Why are they saying this? Let's look at a quick comparison. Traditional cross-border remittances are slow and expensive, bogged down by intermediary banks. But if you use USDC on a high-performance chain like Solana, the transaction settles in 5 seconds and costs less than a penny. This is a dimensional leap in efficiency and cost, and it's starting to catch the eye of traditional financial giants. Big names like BNY Mellon are already partnering with Circle to allow clients to directly convert fiat to USDC. Data from the Bank for International Settlements confirms this trend, showing that major cryptocurrencies facilitated around $600 billion in cross-border payments in the second quarter of 2024 alone. There are 2 points here that I think are really worth digging into. First, USDC and USDT are on two completely different paths. USDT, with its first-mover advantage and massive liquidity, dominates emerging markets and the crypto-native trading world. But USDC's target is crystal clear. It's going after the institutional and corporate market. Its core competitive advantage isn't really the tech. It's the layer of trust it has built at all costs. Regular reserve audits, proactive communication with US regulators. Circle has branded itself as the safe, compliant option for a heavily regulated major bank or multinational corporation. That certainty is everything. So you can think of it this way. Circle is selling Wall Street a trusted, compliant digital dollar solution. The stablecoin war is bifurcating into two distinct battlegrounds. Second, if we zoom out to the bigger picture, this could accelerate global digital dollarization. Think about it. When businesses and individuals worldwide can use an efficient, low-cost digital dollar network for international trade and settlement, it effectively bypasses many countries' complex capital controls and unstable local currencies. This essentially builds a new, more efficient superhighway for the US dollar to travel on globally. It's fascinating because many thought crypto would challenge the dollar's hegemony. But a stablecoin like USDC issued by a US company regulated in the US and pegged to the dollar might actually become a powerful tool for America to extend its financial soft power in the new digital age, further cementing the dollar's central role in the global economy. Okay, let's get to the next story, which is all about global expansion, starring Coinbase. Coinbase has made another move, this time increasing its investment in India's top exchange, CoinDCX, pushing its post-money valuation to a solid $2.45 billion. This isn't the first time Coinbase has backed them, their venture arm. Coinbase Ventures has participated in several previous rounds. When I saw this, I thought Coinbase's approach to global expansion is getting incredibly savvy. Here's why. The Indian market has enormous potential. It's full of young tech-literate people, but at the same time, its regulatory policies have always been murky, even restrictive. It's a classic high-risk, high-reward environment. For a publicly traded US company like Coinbase, going in directly and setting up shop would be a massive operational and compliance headache. So look at the play they're making now. It's brilliant. This is a classic venture capital as diplomacy model. Instead of going head-to-head with the complexities, they choose to invest in and support the local champion. The advantages are huge. First, it's low risk. They use capital to gain market exposure and invaluable intelligence, and they can influence the market's development from the inside, all while avoiding the political friction that a major American company might face operating directly. This isn't just a financial investment, it's corporate diplomacy, building a global network of allies. Second, this is a contrarian bet on eventual regulatory normalization in India. Think about it. Giving a valuation as high as $2.45 billion when the regulatory future is still uncertain is a powerful statement. It shows that Coinbase's leadership believes the country of India's scale and technological prowess can't afford to sit out the digital asset revolution forever and will eventually establish a workable regulatory framework. They see the current uncertainty as a strategic window of opportunity to get in. This is a long-term play, and if and when India's regulatory situation clears up, Coinbase, through its deep ties with CoinDCX, will be in a prime position to capitalize on the market's explosive growth. Finally, let's turn our attention to the latest technological developments in the Ethereum ecosystem. Ethereum's next major upgrade, codenamed Fusaka, was recently successfully activated on the Sepolia testnet. You could call this its final and most important dress rehearsal before its mainnet launch, which is expected this December. At the heart of this upgrade is a technology that sounds a bit complex but is actually quite straightforward: peer data availability sampling, or peer DAS. In simple terms, it changes how Ethereum validators verify data. Previously, validators had to download the entire block's data to do their job, which was slow and storage intensive. With peer DAS, validators can now efficiently complete their verification work by randomly sampling small data fragments from other nodes on the network. The impact of this upgrade is profound, and I see two key takeaways. First, it will fundamentally change the cost structure for all Layer 2 networks. The arbitrums and optimisms we use today have one major cost: publishing their transaction data back to the Ethereum mainnet to ensure security. The Fusaka upgrade and the full danksharding that will follow are designed to provide these Layer 2 seconds with a massive and extremely cheap space for data publication. In the future, this cost could drop by 1 or even 2 orders of magnitude. What does this mean? It means our transaction fees on Layer 2 will become incredibly low, almost negligible. This will dramatically boost the competitiveness of the entire Ethereum ecosystem and could attract many users and applications currently on other blockchains back to Ethereum. Second, this upgrade is a huge win for decentralization, because validators no longer need to download and process massive amounts of data. The hardware requirements for running a validator node like disk space and bandwidth will be significantly reduced. This means that in the future, more individuals and small teams will be able to run their own independent validator nodes instead of being forced to stake their ETH with large platforms like Lido or centralized exchanges. We all know that staking centralization has been a long-term risk for Ethereum. The Fusaka upgrade provides a very effective technical solution to counter this trend, which is crucial for maintaining the long-term security and decentralization of the Ethereum network. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical, wealth-relevant insights from the Web3 world. Our goal with these curated updates is to help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comments section below.
These are high rebate offers we've secured for our community, designed to help you save on costs as you invest. Let's stay rational, move steadily, and grow our wealth together in the Web3 space.
May all of your crypto assets see steady growth. We'll see you tomorrow.